Good evening, everybody. Professor Hasse here. Week 6 of our Accounting Finance MBA class for this summer. 2 more weeks to go after this week. Thank you for being patient with me last week in week 5. My wife is battling an illness, and it took us away for the evening, and I apologize for that, but I hope you watched the video of last week. Tonight, we're going to concentrate on a couple of things. We're going to review assignment 4, which has been posted, which concerns itself with chapter 12 of our textbook, the statement of cash flows. That assignment 4 work is due on Sunday, July 20th. Again, extensions are available if you need extra time. And also the case paper, which concerns itself with chapter 13, financial analysis of your companies. We'll be reviewing that and looking at that, and that is due in 2 weeks on July 27th. So those are the 2 works that we have immediately to do. And then chapter 12 is assignment 4, chapter 13 is the case paper study. And then tonight we're going to be talking about some key concepts of managerial accounting, chapter 14, and begin the discussion of chapter 18, cost profit analysis. Many of you might have heard of this before in the form of break-even analysis, a key component of any strategic planning for many businesses. Next week, we're going to continue our discussions of chapter 18 and then talk about chapter 20, why companies do budgets. What's the meaning of budgeting in corporations, especially at the strategic planning level. And then our final week of study, the 8th week, we'll talk about finance, capital budgeting, and investment analysis. In order to do capital budgeting and investment analysis, you have to do all the first 7 weeks that we've studied in this class. Understanding the financial statements, understanding business or accounting transactions, understanding costs, understanding volume analysis or fixed costs versus variable costs. All that leads into our final study of week number 8, finance, capital budgeting, and investment analysis. Here's where we stand currently and what you have to look forward to over the remaining 3 weeks of our class. And we've gone over this before, but I want to highlight it for people. Assignment 3 grades have been posted to your D2L platform this afternoon. I have yet to update your cumulative grade letter, but the cumulative grade percentage is now posted in your D2L. So all the grades up to this point have now been posted. Assignment 3, I can't talk about it too much because we still have a couple of students have to post their work. But the main problem with assignment 3 was just in the classified balance sheet, making sure you had the proper classifications in that analysis. And so as you see your work, and if you see you got some points taken off, that was the main reason why you did that, and I highlight that in the work that I returned to you. But everybody on the whole did very well. So those grades are posted, and your cumulative percentage grade is now available. So with that posting of assignment 3, we now have 40% of our course grade completed, 3 assignments, and the discussion posts. We have this week's managerial accounting assignment 4 with its 15%. You have your case study paper, which is due the 27th, which is another 20%. And then you have your final examination the last week due August 3rd, 25%. So that means 60% of your grade is still to be determined over the next 3 weeks. So if you're on the A- or B level of the class, there's still plenty of time to get that grade average up for the class. And if you have a solid A, which many of you do, you have to be careful. That A can go by quickly with 60% of the course remaining to be graded. So just so everybody should have an idea where you stand in this class and be ready for this final 60% over the next 3 weeks. Now, as I mentioned before, assignment 4 is posted this week. You're doing some statement of cash flow work in regard to the specific company that you selected for this course, and that's covering chapter 12. And I'll go over assignment 4 in just a minute. You also have the case study paper, which has been posted for a couple weeks now, which is also on the company that you designated for this class. And you're doing basically a financial statement analysis, looking for trends analysis. That's chapter 13 of our textbook. And then finally, the final examination of our course, which is 25% of the grade. The bulk of that final examination will be on the final 3 weeks of this course, chapters 14, 18, 20, and 24. There'll be one question each from each of the 3 assignments, but the bulk of the questions will be from the final 4 chapters that we're reviewing these last 3 weeks. Next weekend, or this coming weekend, I will post a review outline for that final examination, so you can see some of the questions that you need to be prepared for that final examination. All right. Final examination is going to cover mainly chapters 14, 18, 20, and 24, but also have one question from our having to do with assignment 1, accounting transactions, one question from assignment 2, adjusting the accounts, and one question from assignment 3, completing the accounting cycle, and one question from assignment 4, statement of cash flows, chapters 12. So that's where we're standing coming into these last 3 weeks. You have an assignment this week, you have a case paper to do, and the final examination, which next weekend I will post a review document so you can see what that examination is going to entail. All this leading up to the final week of the class, Sunday, August 3rd, when you post your final work. Final grades will be posted in this class August 8th. In the next week or so, you'll probably be getting something from our institutional research people about course evaluations for this class. Those course evaluations were due August 6th. I'm going to talk more about those evaluations. I'm a stickler for students doing the evaluations. I think it's an important thing to get feedback from students. I think it's important for you to give your feedback about classes. And so I'm going to encourage you all to do those course evaluations as you wrap up the course in the next 3 weeks. If you do complete those course evaluation or that course evaluation for yourself, I will give you 5 extra credit points added to the final examination work. 5 extra credit points if you complete the course evaluation of this class, and I'll talk more about that as we get closer to the end of class. I hate to do that, but students just don't like doing those course evaluations, and I don't blame you. I mean, enough people are asking you survey upon survey of our students by this friggin' university, and they don't do anything with those results at all. But I know I do a lot of review of those course evaluations. It gives me great feedback from our students. So we'll talk more about that later. Okay, very good. So let's take a look at a couple things that we're working on now. Assignment number 4. All right, let's take a look at this. Assignment number 4 has to do with analyzing the statement of cash flows of your selected company. Now, correct me if I'm wrong, but I think I have the companies that you all have selected. Melissa has Coca-Cola. Ying has Tesla. Alexandra has Apple. Mr. Zhang has Tesla. Mr. Laura has Walmart. Thomas has NVIDIA. And Victoria has Lululemon. And Mr. Griffin has Alphabet. All right. You've all done some work on those already in this class, answered some questions and that sort of thing. But these last few weeks, you're going to be doing a lot of work in relationship to those real world companies that you have selected and applying them to our studies here in this class. And this is the first one. Here I'm asking you to, using your company that you have, find the following information. For the fiscal years 25 and 24, identify the amount of cash provided by the operating activities of the company and the cash that that company paid out for those years in dividends. Well, you need to go to the statement of cash flows to get that information for those 2 years. So I'm just looking for 4 numbers. For 25 and 24, the amount of cash provided by operating activities and the cash that was paid out for dividends. Question number 2, how much did the company borrow for fiscal years 25 and 24 from the financing section of the statement of cash flows? How much did the company borrow? Question number 3, what are some of the investing activities reported on the statement of cash flows for 25 and 24? Well, remember, investing activities could be the purchase of fixed assets. It could be the buying of additional companies, any type of investing that the company does. It could be buying investments. It could be investing in the market. It could be buying back stock of their own company. I want you to list me the investing activities from the statement of cash flows for 25 and 24 for your company. Finally, I'd like you to tell me in question 4, in your opinion, how would you interpret whether your selected company is cash rich or cash poor? By looking at the firm's cash balance for 25 and 24, and also compare it to a competitor that you select of your company. For example, if I was Melissa, and I'm probably helping out Melissa by this, if I was Melissa, she has Coca-Cola. Well, I probably would go out and pick PepsiCo as a competitor, and I would take a look at their cash position and compare it to my company's. Am I cash rich or cash poor? Your definition of that is for you to find out and compare it to a competitor of your company. Now that those are the 4 questions, actually you can see they all concern themselves with the statement of cash flow. You're doing an analytical analysis of the cash flow position by operations, financing, and investing. Now, you do not have to post in your work the statement of cash flows. You do not need to copy it. You do not need to print it. I have all that information because I know all your companies. So you don't have to give me the statement of cash flows. I'll have it right in front of me. All you have to do is give me the answers to these questions. And naturally, in question 4, you're going to give me a little bit more explanation, a little bit more writing on that. But you do not have to give me any of the financial statements of your company, specifically the cash flow statement. I have all that data. You answer the questions. All right. That's what I want you to do for this assignment this week is do a review. Now, the next question is, Mr. Hasse, where in the hell do I find the statement of cash flows? I hope you don't have to ask me that question because you're all MBA students and you should be able to find that information out. A variety of sources. You can go to our D&B Hoovers database in the library. We've talked about this database before in our class. You can go to that database in the library, look up your company, and go directly to the financial statements and find the statement of cash flows for 25 and 24. That's one way of getting the data. Second area, and also for a competitor. In the D&B Hoovers database, they list the competitors of the company, and you can pick one. Number 2, you could go to the company's website called Investor Relations and get their latest financial data. Number 3, you can go to the company's 10K financial report for 25 and 24. That 10K report, which is filed with the SEC, and they list all the financial data of the company. You can get your information there. The last and probably the least place to find the information is just to go to Yahoo Finance or Google Finance and go to and look up the company in those financial databases and get their financial information. Reason why that's number 4 and last on the list is because sometimes the information in Google Finance and Yahoo Finance isn't entirely up to date. And sometimes you might get some wrong data, and then you'll get the problem wrong. So make sure you get correct data, up-to-date data for the fiscal year for your company, which will probably be December 31st, 25 and 24, and do this analysis of statement of cash flows. Now, where do I find these information about this? Well, let's look at this. In your text, chapter 12, it talks about the ins and outs and the definitions of statement of cash flows. This can be your reference material of looking at and understanding what is in the statement of cash flows. Here's a sample taken right out of the textbook for this company called Genesis. Their statement of cash flows using the indirect method. If you remember that video I showed you last week, the indirect method is usually the method used by 90% of companies. And here in this indirect method, they break their statement of cash flows down into cash provided by operating activities, cash provided by investing activities, cash provided by financing activities. The total shows the net change for the year of cash flow going out. It's going to $17,000. So the statement of cash flow, that's one of the main financial statements, especially leading into financial study or financial management of a company. And I want you an assignment to do some work on that information from your companies that you have selected. 3 of the answers is just giving me the data. The 4th answer is a little interpretation because you're going to be determining. Now, if I was doing Genesis here and I see their statement of cash flow showing that they have $17,000 of cash, I would say, based on looking at the company's overall financials and their balance sheet and their income statement, I would say that they're probably cash poor. Not much cash. Now, where I would back up that interpretation is I would go to a competitor of Genesis, find what their cash position is for those periods of time. And let's say their competitor has $1 million of cash. Then I know they're really cash poor because they have a competitor that has a lot more cash than they do. That's the purpose of that question number 4. I want you to interpret by looking at the bottom line of the statement of cash flow, how much cash they have. You might want to take a look at their trends in their balance sheet over the last few years. Do they have been accumulating cash or losing cash? And determine by their being cash rich or cash poor by looking at a competitor as finalizing that interpretation of that question. So that's what I want you to do for assignment 4. Pretty quickly can be done. The question is, where to get that information for your company, and then analyze the sections of that, and then find a competitor. Again, the D&B Hoovers database is a nice place to gather all that information in one fell swoop in your Wilson Library database, D&B Hoovers. But you make the choice of where to get that data. Any questions from our audience about this specific assignment? Cool. Okay. Now you're also working on over the next weeks, and this has been already provided you a week or so ago, where is it? The case paper. This case paper is an APA formatted paper where you're doing an analysis of your company. A financial statement analysis and interpretation, and a ratio analysis of your company. This is due July 27th, And it's basically using the information given to you and talked about in chapter 13 of your text, and we'll take a look at that in just a minute. So remember, you're due to pick out one equation from the 4 different groups of financial analysis: liquidity and efficiency, solvency, profitability, and market prospects. One equation. And then you would go to the most recent fiscal year, which could be 12/31/25, or it could be 12/31/24. Depends on what your company's at, but it's probably be 12/31/25, and compare it to the 12/31 of the prior year. So 2 years doing this analysis. Once you provide that data of 4 equations for those 2 time periods, then I'd like you to do an interpretation of that work. This is the main part of the writing paper, but you incorporate this data in your paper. Has the firm improved their performance from the previous year? Is the firm managed efficiently? As a potential investor, would you consider this a stock that you would purchase? This is the questions you're trying to answer and interpret by looking at the trends of those 2 years of those particular 4 areas of financial statement analysis. APA format, a minimum of 5 pages, a maximum of 10 pages. And remember, an APA format has 1 page for your title page, has 1 page for your abstract, and has 1 page for references. That's 3 pages in itself. So if you want to stick to 5 pages minimum, you just need to write 2 pages worth of stuff. Not too much. But I need you to be detailed. I need you to interpret what this information tells you in regards to these 3 questions. You might also want to compare this information to industry standards. What are the industry average that the company is in? One way of analyzing how efficient and well managed they are, how are they in relationship to their industry, their competition? Again, you can get this information from D&B Hoover's database about industry averages. You can get the information from recent 10K filings. Same information that you're basically getting for the assignment 4. You're just now looking at the income statement and the balance sheet to find these 4 equations. Now, what do these 4 equations look like? Well, here we go. Here's a page taken out of the textbook where it gives you 4 examples of those areas of financial statement analysis that I'm asking for: liquidity and efficiency, solvency, profitability, and market prospects. So you are to pick one equation from each one of these 4 groups, not 2, not 6. I want to see 4 equations for 25 and 24. So you might pick the current ratio. You might pick the debt ratio. You might pick the profit margin ratio. You might pick the price earnings ratio. Those all 4 tell you something and tell you a lot about those 3 questions that I'm asking. You compare those to the industry. You do a trend analysis for those 2 years. How has those ratios changed in those 2 years? And then you write it out and explain it in your paper. So you're doing what is called the basics. If any of you are going on to a doctoral study in finance, God bless you. Or if any of you are going on to a career in financial statement analysis, or being a treasurer of a company, being an entrepreneur of a company, these analysis, these interpretations of cash flow in assignment 4 and financial statement trend analysis and interpretation in chapter 13, which you're doing in this case paper, are key to managing financial management of a company. Huge. And this is good practice for you to understand that and interpret it. So again, this is taken right out of your textbook. These are the areas that you select from. If you don't have one equation and you make up an equation or go to some other source, you're going to get the problem wrong. So make sure you select one from each one of these four groups and then locate the information, do the analysis, and then interpret that analysis in your paper. And again, you can get this information very easily from a variety of sources that I mentioned earlier about assignment 4. Okay. If any of you have a problem with understanding the APA format in the case paper, oops, wrong one, sorry. I have given you a link to a definition of APA style format in your presentation area of that work. So these are the two bit assignments and tasks that you're doing over the next couple weeks. This week, you're doing a statement of cash flow analysis taken from chapter 12 and your case paper, which is a little bit more detailed study, what you're doing on chapter 13 and all that data. You know, I would probably, if I pick whatever equation you pick for each one of these four groups, you understand what those numbers tell you. They're defined in chapter 13. What is the definition of that ratio or analysis and what does it mean? And how you interpret that is what I'm looking for in this paper. All right. Anybody have any questions in regards to the case paper due on July 27th? Okay. Over the next few weeks, I will be available if you are running into difficulties, don't understand something, are getting backed up with other work that you're doing this summer. You're good. These two both have extensions. You can take extra time, extra days to do them. All right. So you don't have to worry about that. I just want to make sure you do it correctly and properly. If you have any questions about finding the information correctly, I'm not going to find the information for you, but if you tell me what difficulties you have, I'll point you in the right direction to complete this work. But there's plenty of videos that we've already looked at that are in our playlist in your week's file folders, defining these analysis, defining these work. Please refer them if you need some backup. Jason, you have a question?
Yes, and I think it's a dumb one, so please, no one laugh at me, please. I saw you mentioned earlier the DMB Hoovers, and I looked it up. Is that something that we have access to through the student portal? I'm not sure if I heard you correctly, if that was discussed in the first week, because I was absent that first week.
You were absent that first week when I talked about this. All right, I'll do this for everybody. This is a good refresher, Jason, and that is not a dumb question. And I don't like when students say that. There's no question that's not dumb. But here is where you would go for that, okay? So follow me on this. Hang on, let me just bring this stuff up. Okay. Here's my blank browser. Alexandria, do you see it on your screen? It says Google.
Yeah, I see it.
Okay, very good. So I go to the University of La Verne website. What the hell is that? Okay. All right. And I go to academics, Jason, or anybody, and I go down to the Wilson Library. Up comes the Wilson Library Wilson Library webpage for our University of La Verne site. And I would now go to databases. You all of you, if you ever looked at your bill from the University of La Verne, and you should if you have not, you should be understanding what the University of Laverne charges you besides tuition at the university. And one of the things they charge you are for student fees. Part of those student fees are used to pay for this database that you have access to. So you're paying for this. Another good thing about this is once you graduate and you no longer have any fees or tuition for the University of Laverne, this database is for you for free going out into the future as an alumnus of the University of Laverne. The catch is you got to graduate. If you graduate, you get it for free. If you don't graduate, nada. Okay. But this is a great, I use this database once or twice, maybe even 3 times a week when I'm looking at companies, looking at things that I want data for. It's a great database. So here I go. It says databases by subject. I click on business. Up will come D&B Hoovers. Remember when we went over this, there's a woman in our library. Her name is Linda Gordon. There's her phone number. You can email her. Her sole job is to help you guys do your research, help you find things. Now, I can help you too, but Linda is a professional at this. She's a professional librarian. She's an MBA graduate. Also, she's a law school graduate. She's a pretty sharp dude. Besides that, her job is to help you over the internet with any research problems. You might say, might email her and say, Miss Gordon, I'm having a heck of time trying to find this information for Mr. Hassey's paper. And she knows me very well. She says, I know exactly what you're looking for. Let me show you how to use it. And she would probably refer you to D&B Hoovers. So I click on D&B Hoovers. Now you have to be logged in with your user ID and your password for Laverne. So always remember that. And up will come the D&B Hoovers opening page. You just go up here to search for companies and type in the name of your company. So let's say I'm trying to find Ford Motor Company. Up will come right at the top of the list, Ford Motor Company. Don't pick Ford Motor of Canada or Germany. Just pick the one on top. You click on that, and up will come everything you wanted to know but were afraid to ask a Ford Motor Company. And on this left-hand column is all kinds of information, financial information. Click on that. It gives you a lot of ratios of the company. How about that? You can go here to company overview. You can go to industry overview, look at industry average of the automobile industry that Ford is in. All kinds of information about Ford. Analyst reports. All kinds of stuff. So that's the D&B Hoovers database. Their financials are in here too. I'm not going to show you where that is. I want you to find it. But that is the D&B Hoovers database. For every publicly traded company in America, their information is included in this database. And I know all your companies are in there because you're all American companies and you can get this information. Now, again, you don't have to use D&B Hoovers. You can use whatever source you use, but you have to make sure you let me know in your paper what was your reference source for this data. But Jason, this is how you get to and use D&B Hoovers. Linda Gordon is the contact, but also, as I said earlier, you say, let's say, Jason, you're working on this coming weekend, and you're having a heck of a time with D&B Hoovers. Nothing's not working right. You can let me know, and I will point you in the right direction of where to make sure how you solve the problem of finding your data. All right. Did I answer your question, Mr. Griffin?
Yes, sir. Thank you. My apologies
Okay.
for you having to take time out of the day for it, but I truly appreciate it, sir.
No worry, Jason. Thank you. Okay, so that's how that all works. So this is even for other classes that you have in the program, or even for your own personal use. Geez, you're thinking about investing in Ford? Go to the analyst reports. And here are a bunch of stock analysts that give you their review of Ford currently right now. Looks like they don't think very highly of it, but this is information about that. They give you a SWOT analysis of the company. Some of you are taking management courses. SWOT analysis are quite prevalent in looking at data for companies, strengths, weaknesses, opportunities, and threats of a company. Their industry competition. Their industry overview. All kinds of information. So you can play with this, just jump around it and see what it gives you about your company. This can help you a lot in both these assignments that you're doing over the next couple of weeks. So again, D&B Hoover's database, Linda Gordon. It's located in the Wilson Library under the database topic of business. And again, I'm recording this. If any of you get lost or have a difficult time, you can watch the review of this video to help you track it. And you go to the Wilson Library under academics, and you want to click on the databases to find this work. But more importantly, there's a lot of people at this library site. You're graduate students. You do research. All our graduate students do a lot of research. There's people at the library online that can help you if you get into problems or having a difficult time. Again, I also can help you. I did this for years, and when I went in graduate school, all these research things I did. So this is good for you to do this and get this information and know where it is. It'll help you in other courses as well. Okay. Boy, we've covered an awful lot of material already here. Okay, now what I'd like to do, find it. Oh yeah, here we go. Is go back to our D2L site and go to last week, week 5. All right. The lecture video will help you with discussing some of this statement of cash flow stuff. Here's good information, a good video on statement of cash flow, a good video on financial statement analysis. These could be good reference sources for you in your work of the next couple of weeks. This week is week 6. We talk about managerial accounting. We're going to concentrate for the next few minutes on chapter 14 and get a little bit into chapter 18. What is managerial accounting? And remember, and you'll get an outline this weekend. The final examination in a couple of weeks is going to be mainly concerning itself with the final 4 chapters of our course, chapter 14 and 18, chapters 20 and 24. That's where the bulk of the final examination work will be in our last work for this class. Okay, so let's bring up. Let's talk about managerial accounting. And I'm sure many of you in your current jobs, many of you in your current responsibilities in your companies probably are more managerial accounting people than you are financial accounting people. Not many of you are CPAs or produce income statements or financial statements or do recording of business transactions that we did for the first half of this course. Many of you look at budgets. Many of you look at data that the accounting office provides you about your organization, about your department. And that's called managerial accounting. Managerial accounting provides financial and non-financial information to an organization's managers. Us, we're managers. It's used in planning. It's used in control. It's used in determining what our costs are. Should we build a new factory? Should we develop a new product line? I'm sure a lot of you work in companies and you're always finding a way to try to make more money or stay competitive in your field. Well, to make money, you're going to have to invest money. You're going to find the capital. You're going to find the cash to start a new product, to go to a new country to market your product, to invest in technology, to invest in people. Well, what is the data you need to make these decisions? Why are we doing it? Why are we finding why do we have to develop new markets? Why are we have to close a plant because the costs are too high? This is what managerial accounting is all about. Remember, we talked about this on our very first weeks of class, which we took the first, excuse me, which we took the first half of the class, we concentrate on financial accounting, preparing the financial or monetary information about the transactions of the company. Managerial company is for internal users, whereas financial accounting is for external users. We're preparing financial information for our investors, for our bankers, our creditors, for the government, for the SEC. External people read our financials. Managerial accounting is for internal uses, managers, department heads, internal review of the accounting information. That's the difference between financial and managerial accounting. One of the key areas of managerial accounting is into fraud and ethical issues within a company. Are we committing fraud? Are we misleading our customers? Are we misleading the government on our tax returns? Are we misinforming our investors about our company performance? Well, these, if you're doing them on a regular basis, will lead to lawsuits, will lead to criminal time. The Sarbanes-Oxley law that was passed by Congress after the Enron fiasco of the 1990s. If you're a director or a manager of a corporation and you commit fraud, if you lie on your financial statements, if you lie on your tax returns, you can go to jail, in addition to paying any civil lawsuits against your company. You can go to jail. So fraud and ethics have a lot to do with the information provided, managerial or internal information. Two types of costs in managerial accounting. Direct costs, which can be directly associated to the product or service you're performing. Direct costs for a bicycle are tires, seats, handlebars, pedals, brakes. They're actually involved in the bicycle that you're producing per this frame. Indirect costs are costs that you have, but they're indirectly associated with your product. Accounting costs, rent, managers' salaries, insurance, depreciation. Those are all legitimate costs of your company, but they're not directly needed to produce the bicycle, but they're still a cost of the business. One of the key points of managerial accounting is, okay, what are the direct costs of our business and what are the indirect costs of our business? Another name for indirect costs is called overhead. Many of you probably have managers or work in a business setting where one of the key points of your efficiency in managing your company is, are you keeping overhead costs down? Are you keeping administrative costs down? Are you finding cheaper places to build, rent? Are you keeping track of lowering your insurance costs? Indirect costs are overhead costs. One of the main ways that companies change their business strategy is to lower their overhead costs. Why do a lot of American companies build products in Vietnam and China and Latin America, Mexico? Why? Cheaper indirect costs. It's cheaper to do business there. Cheaper rent, cheaper employees, very little taxation. One of the reasons why our President, Mr. Trump, has tariffs is to make companies stay in America so they don't go to other countries and try to save on these indirect costs with tariffs. Those make those costs go higher because the government is charging those products you build out of the country. When you bring them back into the country, that's an additional cost to those products, which reduces the benefit you got from moving out of the country. That's why Mr. Trump is doing these tariffs. He's encouraging business to stay in America. Also, there's some other alternatives to this, and I'm not going to get into it because it's political interpretation by myself, and I'll stay away from that one. But as a business perspective, the reason why all you read about these days is tariffs. It's to balance the cost of producing a product outside the country to producing the product inside the country. And that's the main purpose of that. The different types of direct costs. Materials. What are the materials we need to produce our product? Labor. What is the labor it takes to produce our product? Factory overhead. What are the indirect costs of producing our product? Well, we have materials, we have labor, but also we have maintenance workers in the factory. We have utility costs in the factory. We have insurance costs in the factory. These are costs associated with our product. They're called overhead. That's another rate, what we talked about, indirect costs. Then we have what are called prime and conversion costs. A prime cost is those costs directly associated with producing the product, material and labor. A conversion cost is the cost or the cost associated with overhead. In other words, overhead costs come from a variety of areas within your company, and they're assigned to different products. For example, all of you know by being students at the University of La Verne in the MBA program, you have academic advisor. Your academic advisor is to help you pick classes, help you pick the right professors for you, that sort of thing. Many of you probably have Randa. Excuse me. She's an academic advisor for graduate students in the College of Business. Randa is a overhead cost for the university. She's not like me. I don't teach you. She's not like the internet or the classrooms that you use to learn your classes. She's an overhead cost. But Randa services many different students. So one of the key areas of allocating Renda's costs of academic advising is converting those costs to the appropriate areas of study. So a certain amount of Renda's costs are applied to this course. A certain part of Renda's cost of your academic advising goes to another course that you all take. That's why it's called a conversion cost. You're allocating those costs to a particular cost center. The cost center in this case is this class, Business 600A. So to produce a product requires three different costs. Materials and labor are direct costs, and factory overhead. This is one of the key points of managerial accounting. I just had a former student the other day who just got a job as a manager of an In-N-Out burger. And she is now managing an In-N-Out burger, has about 30 employees she's in charge of. And the reason she contacted with me, and I'm not saying that I'm any good, but the reason she contacted me, she said, Mr. Hasse, I just started my first week at In-N-Out Burger, and they're asking me for an analysis of our cost of producing one hamburger. They want to know how much labor it takes to make a hamburger, how much material costs, meat, bread, whatever, and what's the overhead of our business at this store. That's exactly what we talked about in accounting. I just wanted to let you know about that. Companies do this all the time, analyzing what it costs them to produce, because they want to make sure when they charge the retail price of that cost, they're getting reimbursed plus making a profit of those costs. So this is the definition in managerial accounting of a product cost, the cost of producing something. In Laverne, it would be the cost of providing you a class and education. At Ford Motor Company, it'd be the cost of producing a car. Whatever. That's a product cost. And another second area of costs is right below that. They're called period costs, non-product costs, selling expenses, and G&A expenses, general and administrative. If I worked in the accounting office of a company, I have nothing to do with producing the product that we make, but I have everything to do with providing backup information, data, working in the accounting office. I am considered a period cost, a G&A expense. If I work for a company and I sell the product to my customers, I'm a salesperson. I'm in advertising. I'm a period cost. The key definition between these two things, besides one has associated with the product, another is non-production costs, is there's a time period for these two types of products. A product cost is what are the costs producing a product. But also, once you produce the product, it goes into an asset account called inventory. And it sits in inventory until you sell it, and then it becomes an expense. So you can make a product in November of 2024, produce it, and sell it. It's put it into your inventory, and it sits in your inventory on December 31st as an inventory asset. Then in January 25, when you sell it, it now becomes an operating expense of the company because you've now sold the product. So they can go across fiscal years through inventory. The difference between product cost and period cost is period costs are for a specific fiscal year. They don't go back and forth doing from fiscal year to fiscal year in the form of inventory. What are your costs for 2025 selling expenses? What are your costs for 2025 for G&A expenses? And that's it. And then you start that up again in the next year. Product costs can go from period to period in the form of being held in inventory until you sell it. Non-production costs are fiscal year costs. They don't go back and forth from different fiscal year. You want to impress me on the final examination? If you give me the definition of product and period costs in that format, that's a good answer, which you might see that question on the final. So that's the two determinants of costs, product and period. You might want to think the company you work for now, where are you in their costs? Are you period costs? Are you a selling expense, or are you G&A? Or are you actively involved in the production of your product or service at your organization? Where do you sit in the determination of product and period cost in your company? Because that's how the managers determine your value to the organization. It's important to know that. And here are some examples of product versus period costs. This is a good slide taken from your textbook. Direct costs, labor and overhead. Indirect costs, direct costs, labor and materials for a bicycle. Indirect costs or overhead, anything that, as you can see here, is factory related. And then the period costs for the bicycle company, selling expenses and G&A expenses, accounting, HR, office rent, notice office is the key word there. Period costs are for fiscal year. Product costs go from different fiscal years because they don't become expenses until you sell the product. They don't become expenses until they sell the product. They're inventory as you go through the cycle. This is a good slide. And here's an example of that here. We're looking at 2021. Look at the product costs. You build something, you put it in inventory. Okay, it's setting in inventory ready to be sold or on the shelves of a store. If you sell it, notice it goes to the income statement as a cost of goods sold. It becomes an expense. If you don't sell it, it stays in inventory and goes on the balance sheet for that year end. Then in the next fiscal year, 2022, when you do sell that inventory that has yet to be sold and you sell it, it becomes an expense in another operating year because you no longer have it in your inventory and it's been sold. Notice above that the period costs. Those period costs are only in 2021. In the year selling and G&A expenses in the year they were incurred. None of those costs transfer over to the next fiscal year. They're tied directly to the fiscal year that they were incurred in, where product costs do not become an actual cost or an expense until they are sold out of inventory. Perfect example of that. The good thing about all this, you guys, is you don't have to worry about this in doing journal entries or keeping track of the trial balances of all this stuff, because that's what this class is not about. It's getting the big picture of what managerial accounting is. There will be questions about just chapter 14 on the final examination, and I will show you types of questions and examples in the overview or the review paper I give you this coming week for the final. Okay, so that's a key component of managerial accounting, understanding costs, and that's what chapter 14 is all about. Okay, we're going to take a little break. When we come back from our break, I need time to reset my computer. We're going to talk about cost behavior. Chapter 18, identify break-even point. One of the reasons why that student of mine called me up the other day, who's now a manager of In-N-Out Burger, and she was doing all this work as a manager, her supervisors or her district manager for In-N-Out Burger wanted to know how many hamburgers do they need to sell every day to break even. How many hamburgers do they need to sell in order to make a profit at In-N-Out Burger? And that's a very important example. Another example has to do with the University of La Verne. At the University of La Verne, if we have 7 or less students in a class, the university loses money. That's why many times classes with 3 or 4 students end up going to directed study. And I'm sure some of you have been involved in directed study. In other words, they're not teaching the class because they're not covering all their costs. So they go to directed study where they pay the professor a hell of a lot less just to break even with those smaller amount of students. This class has 8 students in it, just enough to break even, where the university is covering all their costs in this class. Why is that important? Because you want to know, as a manager, are we paying for or covering all our costs in the retail price and service of our product? That's what chapter 18 is about, cost behavior, the break-even analysis, and we'll be going over this when we return in 10 minutes. So I'll see you all at 7:13 p.m. to pick up on chapter 18, cost analysis. See you then. Okay, we're back. Tonight, our topic of our lecture for week 6 is managerial accounting. What type of information is provided managers for internal use within a company? If we were determining managerial accounting for us as individuals and our own family management, Managerial accounting would be an analysis of what we spend on groceries every week. How much do we pay in rent? If we're spending too much on groceries, more than we really are making in income, what are we going to do about it? Cut out certain things, find a cheaper place to buy groceries. If we're paying too much money in rent and we can't afford it, we shouldn't borrow more money or put our rent on our credit card. We need to find a cheaper place to live. Easier said than done, but that's what managerial accounting would be for an individual. For a company, it revolves around what we discussed the first part of our lecture this evening. What are our costs? What are our product costs? And what are our period costs? What are our direct costs? And what are our indirect or overhead costs? That's what managerial accounting is, to identify those costs. Chapter 14. Now, coming back from break, what are those costs? How do we use costs and the definition of costs to analyze our business? Those types of analytical questions are talked about in Chapter 18. How many units do we need to sell to break even? What sales volume do we need to meet targeted income? How much will income change if we buy a new machine or reduce labor costs? What is the change in income if selling prices decline and sales volume increases? How will income change if we change the sales mix of our products and services? All questions that financial managers use, taking information provided by the financial accounting people and using that information to make internal decisions. One of the biggest decisions now for many companies over the last few years having to do with COVID is, how have our costs changed due to supply chain issues? Our supply chain has changed. We no longer use China, we use Mexico. We no longer use one country, we use another. How has supply changed? And many of you know this in your cost of doing everyday business. Another managerial or cost behavior review is what we talked about earlier. How do tariffs influence our business? The charges that the government cause as a tax on goods coming into the country from other countries, a tariff. Another big area of managerial accounting and cost analysis is, what if we decide to develop a new product, a new market? What is it going to cost us? And what is the potential income or profit generated off that change? All these are talked about in Chapter 18. One of the costs that we didn't really talk about in Chapter 14 is another definition of cost called fixed costs. What is a fixed cost? Costs that do not change even though volume might go up or down. In other words, if I was producing a bicycle that we talked about earlier, if I produce more bicycles, the volume increases of producing more bicycles, naturally my labor and material costs will go up. I'm producing more bicycles, the volume is increasing, those costs will increase. But if I'm a manager of that department that produces that bicycle, and my salary is fixed to manage that department, in other words, no matter how many bicycles we produce, I get paid the same amount of salary, then I am called a fixed cost, because I get paid a salary and that has no influence on the production or volume of how many units we're producing. That's a fixed cost. The other side of that is variable costs. Back to my definition I used just a minute ago, a variable cost would be the labor and materials used to produce the bicycle. If we produce more bicycles, those costs increase. If we produce less bicycles, the costs will decrease. But the fixed cost, the salary cost, would stay the same. That's why it's fixed. So variable costs are costs that change in proportion to volume. Of any definition from Chapter 18 that you need to be familiar with, it is what is considered a variable cost and what is considered a fixed cost, because that tells us a lot about our cost structure in our business. Here are some examples of fixed and variable costs. Do not worry about mixed costs. That just confuses everybody. We'll just concentrate on fixed and variable. A fixed cost, as I said, is a cost that has nothing to do with the volume that we're producing. Examples: rent, property taxes, insurance, salaries, depreciation. We produce 1 unit or 1,000,000 units, we still have those core costs. Variable costs change with production. Direct material, direct labor, packaging, shipping, indirect materials. Yes, the more we produce, the higher the cost. Mixed costs, again, you don't have to be familiar with mixed costs, but if any of you have ever gotten your Southern California Edison bill, you will notice in that bill that there's some costs in your bill that are fixed, that never change, and other costs that do change. It's in relationship to the volume of your electrical usage. You are charged a basic rate for your electricity. That's a fixed cost. But then if you use more power, especially in the summertime, the variable portion of that bill goes up. So you would consider electricity or utilities a mixed cost. You're paying a flat fee plus extra for the usage that you make. That's a mixed cost. So, but you need to be familiar with what is a fixed cost, do not change with volume, and a variable cost that change with volume. And here's the reason why. It's called the contribution margin. The contribution margin is the selling price per unit of a product minus the variable cost of the product per unit. So let's say we're producing something and we sell it retail to our customers for $100. That's what they pay for the product. Our variable cost, materials and labor to produce that product is $70 per unit. So our contribution margin is called $30. We're selling it for $100. Our variable costs are $70. So our contribution margin is $30. Or you could also say our contribution margin ratio is 30%, the relationship of the margin to the selling price. And that's important to know. And here's another reason why. So what is the contribution margin of our product? In this case, the difference between selling price and variable cost per unit. We use this contribution margin information to determine our break-even point. That point in sales where sales equal the total cost of producing that product. Thus, the net effect is zero income, profit. So we can do the break-even point to find out how many units do we need to sell to break even. As I indicated earlier in my example, if our break-even point for University of La Verne is 7 students a class. Matter of fact, if any of you mentioned this to anybody outside this class, I'll deny that I told you this 7 student figure, because I'm not really supposed to tell you about that, but the hell with them. So the break-even point is if we have 8 students in a class, we're making some money. We have less than 7 students in a class, it's costing us more to provide that class. An important thing to know as a manager. Well, here we have determining the break-even point in units and in dollars. And this is the formula you need to be familiar with coming out of Chapter 18. How do we determine what is our break-even point? And what it is in units is you take your fixed cost, okay? Remember the contribution margin is 30 bucks, which is the difference between retail and variable cost per unit. But also remember there's fixed costs involved in producing a product. And in this case, it's $24,000. So what is our break-even point? You take the fixed costs and divide it by the contribution margin per unit. 24,000 divided by $30, that's 800 units. So if we sell 800 units, we're not making any profit. In other words, we're covering all our costs. The variable cost per unit of $30 and the fixed cost of $24,000. 800 units. Another way of determining that in dollars is taking the fixed cost and dividing it by the contribution margin ratio. Remember, our contribution margin ratio was the percent of variable costs, or excuse me, the contribution margin to the selling price, 30%. So if we take $24,000, our fixed costs, and divide it by 0.3 or 30%, we get $80,000 in sales, which makes sense. If we're selling our product for $100 a piece and our break-even point in units is $800, 800 times $100 is $80,000. So those are two important numbers to know. How many units do we need to sell to cover all our costs? And what is that in dollars? These are two important formulas out of Chapter 18 you need to be familiar with, is how to determine that amount. So no matter what company you're in, there's probably somebody in your organization that knows exactly how many units or how many products you need to produce and sell to make money. For example, in this case, if we sell 801 units, the contribution margin of $30 becomes our profit margin. If we sell 802 units, we're now making $60 profit. If we sell 803 units, we're now making $90 profit. Once the break-even point is reached, your contribution margin becomes your profit margin. I'd remember that line too. Once break-even point is reached, your contribution margin becomes your profit margin. If you are, especially some of you, if you're working in a company that produces mainly just one product, I'm sure if you go to your controller or your VP of finance or your CFO and say, hey, dude, what's our contribution margin in this company? And they tell you, well, Alexandra, our contribution margin is 800 units. Oh, what's our contribution margin per unit? $30. Oh, so last month we sold 1,000 units. So that means we sold 200 units more than our break even. So 200 units times 30 bucks. Oh, we made $6,000 in profit last month. Damn, how'd you figure that one out? Oh, I know. You have HASI in accounting. You know what that means. Once you reach the break-even point, your contribution margin is your profit margin. When I was running my business for many years, on the first day of the preceding month of a business, my office manager brought into me the information for the prior month. And she said, oh, Mr. HASI, we had 1,000 billable hours this past month of our business. I go, thank you. Because I knew when she told me that we made $10,000 in profit last month. We sold $100 more than our break-even point, And without a financial statement, I could figure out what our profit was by just looking at that number. And that was verified when I got the financial statements 4 or 5 days later. But if you know your margins, you can determine immediately how you're doing. This is huge. Somebody will know you're an MBA student when you can tell them the relationship of contribution margin to profit margin, because the contribution margin becomes the profit margin once you exceed your break-even point. One more time. Your contribution margin becomes your profit margin once you exceed your break-even point. And for many managers of many companies, especially on a department basis, that is an important number to understand. And many times you take this contribution margin information and you can produce a different type of income statement. It's called the part contribution margin income statement, or a statement of our break-even point. Remember, in this problem we just did, we determined our break-even point as being 800 units or $80,000 in sales. Well, if I would put that in a formalized income statement, notice I have sales of 800 units at $100. That's $80,000. Our variable cost per unit, remember in this problem, was $70 per unit. If we sold 800 units, that's $56,000. The difference between 56,000 variable costs and selling price is $24,000. And guess what? Our fixed costs are $24,000. Thus, we are making zero profit. Our contribution margin statement tells us that yes, at 800 units, we're having zero profit. All our costs are covered. That's important to know. It's called a contribution margin statement. I would take note of this slide for future reference. Another important title or important analytical information of cost profit analysis is called the margin of safety, which is the relationship to expected sales and what your break-even sales is. What's the leverage or spread between what you expect to sell and what you need to sell to break even? It's called the margin of safety. Some companies like to call it arbitrage. I like margin of safety. Arbitrage is a little too phony for me, but whatever. So let's say in our budget for the next year, we plan on selling $100,000 of our product. We know our break-even point in sales is $80,000. That's a $20,000 difference between what we expect to sell and what we need to sell to cover our costs. If we take that $20,000 as a percent of our expected sales, our margin of safety is 20%. In other words, the higher the margin of safety is in percent, that means the spread between expected sales and break-even sales is higher. Sometimes some companies, if their margin of safety is less than 10%, they're going to be a panic mode a little bit, because that means they might not be making or not planning on making much profit in the next year. And they might want to ask themselves the question, why? Now I'm going to stop here just to be a jerk and wonder why a lot of our students don't have their cameras on in the second half of the class. Does anybody have any problems besides Jason as having a camera on?
I do. I sent you an email this morning. I'm out of town and my service is really horrible out here.
I know about that, so don't worry about it. There we
Okay.
go. Okay, now, because sometimes people tend to maybe take a little nap while the second half of the class and saying, oh yeah, I'll let Hassie talk for a while. He's recording this, so I'll catch up to him later. So don't, I mean, just being a jerk about that. Melissa, I knew about that, so don't worry about that. Okay, so we only have a few more minutes left, so don't anyone fall asleep on me quite yet. So That's where that's important. So if somebody in your organization comes up to you and says, geez, I don't know about this upcoming year, our margin of safety is only going to be about 5%. Whoa, we're not projecting very many sales higher to make money. We're not going to be making much profit this next year when our margin of safety is only 5%. 5% over what we plan on covering just our costs. But if somebody says our margin of safety is 50%, which is what a lot of companies shoot for, to be honest with you, that's plenty amount of extra sales over break even, meaning you're going to be making some money, some profits. 50%, meaning your sales are going to be $130,000. If our sales were 130,000 expected minus break even sales, that's a $50,000 margin of safety. That's a 50% margin of safety. So we're planning on selling a lot more higher than our break even. So margin of safety is just a quick number. Matter of fact, there's a lot of companies in their trend or financial statement analysis might always put in their expected margin of safety for the upcoming year just to give the investor or the analyst an idea of how much profit they'll be making in this next year that they expect over and above the break-even point. So this is the most important things coming out of chapter 18 that I know you can use a lot in the real world is what point of our volume do we cover all our costs? And that's called the break-even point, when fixed costs are covered by our contribution margin, the difference between retail price and variable cost per unit. And that's translated to dollars when we take that fixed cost and divide it by our contribution margin ratio, the relationship of contribution margin to selling price. And we use that also to determine what we consider our margin of safety. What's the leverage? What's the spread? What's the arbitrage between our expected sales and what we need to sell to cover our costs? And that's called the margin of safety. Naturally, as I said, the higher the margin of safety, the more likelihood you're going to be making a pretty solid profit in the upcoming year. This will go back to our discussions next week when we start talking about budgeting and planning. What is our planned sales and how does that relate to a margin of safety in relationship to our break-even point? A lot of budgeting is involved in that. So contribution margin, break-even analysis, and margin of safety are key points to managerial accounting analysis and information. And that's highlighted in chapter 18. So as I said earlier, let's say we had sales for a period of 1,500 units at $100, that's $150,000. We know our variable costs are $70, so if we sold 1,500, there's $105,000. Thus, we're making a contribution margin, the difference between variable and retails, of $45,000. With our fixed costs being $24,000, we know we're making $21,000 of profit because we're $21,000 ahead of our fixed costs, which is our break-even point. These are good analytical data for managerial accountants. Probably doesn't mean too much to you now, but as you all, and maybe some of you are already managers, department managers, store managers, margin of safety and break-even point and variable and fixed cost determinations are huge if you're in charge of a cost center, if you're in charge of a revenue center, if you're in charge of a specific unit within a division or within a company. This is how they monitor efficiency and monitor success at looking at individual departments or product lines in a business. You might all of a sudden see they just recently, and many of you might know this, might not know this, when I was a kid, Sears and Roebuck was a huge store. Everybody bought their stuff at Sears. Now, they just closed the last Sears stores in this part of the area in, where was it, Upland, someplace other, or I can't remember where it was, just recently. Sears are closing their stores. Why? They're not covering the cost of operating the store. Sales volume is down so low that they can't manage and keep that store profitable. So they're closing them. And now they're relying mainly on internet sales. When you see stores closing, when you see businesses no longer doing business in your area, it means either they've gone to the internet to reduce their fixed costs, or they just can't compete anymore in that area. And that's a key determinant of this is their contribution margins, their break-even point. That's why they're closing. They cannot be profitable. And many of us and many of you probably in your own business careers or life will be dealing with this issue. What is efficient, what is profitable, and what is not? Do we cut those costs and cut that department to stay efficient and profitable? Because we're not making break-even point of those areas. That's important to know. And then the last part of chapter 18 you need to be familiar is how do we target income? Let's say we plan on making a profit of $12,000. How many retail sales do we have to make a profit of 12,000? Well, if our fixed costs are 24,000, we just add the 12,000 to our fixed costs. That's 36,000. And we know our contribution margin ratio is 30%. So what is 36,000 divided by 30%? We know we need to sell $120,000 of volume retail to generate a profit of $12,000. This is important because many companies do business to satisfy their investors. How do they do that? Well, next year in 2026, we plan on making a $12,000 profit that we'll distribute to our investors in dividends and interest payments. So now they've committed themselves to me making a $12,000 profit. That means they need to sell at their current retail price and cost structure $120,000 of volume. And that puts a lot of pressure on the sales and marketing team saying, okay, you guys got to sell $120,000 next year. If you don't, we're going to look bad. And if any of you are in marketing or sales, a lot of your work is driven by expectations of making a certain amount of sales quota that will generate a certain amount of profit. How you determine that certain amount of profit is by knowing your contribution margin and your fixed costs. You can determine that. And that's important. You can meet the demands of your business requirements. I have to make a certain amount of profit to keep my investors happy or they'll fire me. Remember, investors, board of directors members, bankers, they have the power. If they're not getting adequate value or return off their investment, they have the power to fire you as a manager of a company. Every day you read about in the newspaper that CEOs are being canned. Why? They're not meeting expectations of profit and return. Well, what does it take me to satisfy my investors' happiness and profit? Well, in this example here, if we make $12,000, our investors will be happy. They'll get their dividend. Excuse me. We'll pay off some of the loans. We'll pay back interest. Everybody will be happy. All right, what do we have to do to achieve that? Well, we got to sell $120,000. That's at $100. What happens if we can't sell our products at $100? We have competition. We're in an inflationary time. But by knowing this information, it gives us the ability to make these strategic decisions of, do we have to change our retail price? Do we have to change our cost structure? Why are Mr. Trump having all these tariffs? Because for Ford Motor Company, it's cheaper for them to build the car in Mexico. They're making their profit margins quicker on their sales. Why is Apple Computer build their computers in Vietnam and China? because the costs are lower, their contribution margins are higher, they make money quicker. Mr. Trump says, the heck with that. We want Apple to build their products in California. Well, Trump won't say that. He doesn't like California. We want Apple to build their products in Texas. Or we want Ford to build their cars in Michigan, who helped me get elected president. So how are we going to balance that? Let's charge tariffs on the cars being made in Mexico. So Ford says, the heck with that. Let's just build the cars in Michigan to avoid those tariffs and not make as much money. Apple says, the hell with that. Let's build our Apple computer. And right now, Apple computer is now looking at some African countries to make their products because it's cheaper and they'll get to profitability quicker. Targeted income, contribution margin, break-even point, all are information that drives these strategic decisions of building your product offshore. Or saying, let's not build our product in California anymore. Let's build our product in New Mexico. And in New Mexico, we're getting some benefits and some deals that keep our costs lower. Okay, let's do that. Let's build our product in Alabama instead of California. And this was why many companies in California are going to other states. Now, the problem with that is, and I'm going to be a little snobby here, but you guys are kind of related to this. One of the problems that companies have when they go and build their product in New Mexico, Texas, Alabama, from California, is the quality of labor in those states cannot match the quality of labor in California. The labor is better. In other words, smarter, less training, more efficiency in producing the product. That's why they make their product in California, because the labor base is better, a better base of choosing quality workers. Where in Alabama, not to be a snob, but this is a fact, in Alabama, Texas, in certain states, you cannot get the quality of labor that you can in California. And that's one of the big arguments going back and forth in American business these days. Yes, it's cheaper to build our product elsewhere, but are we going to spend more money on finding better workers, more qualified workers in those states because they're hard to come by than in California? And that's one of the big issues. This information in managerial accounting help us make those determinations. Okay. Let's stop our lecture right there. Next week in class, I'm going to be looking at some actual examples of this discussion that we talked about tonight in a problem format, and we'll take a look at that next week. Just a sec. Okay, hang on. Be right with you. Okay, here we go. Okay, so just to review what we've discussed this evening, we have two tasks at hand as far as grading is concerned. We have assignment number 4, statement of cash flow analysis for your particular companies due this Sunday. Extensions are available. where you're looking at the statement of cash flows for 2025 and 24 of your companies and telling me some information from those cash flows. You have your project paper, which is a financial statement analysis of your companies, looking at 4 equations from 4 of the areas of financial statement analysis discussed in Chapter 13. Assignment 4 has to do with statement of cash flows discussed in Chapter 12. This all leads to the work you need to do over the next 2 weeks. At the same time, going forward, we have a final examination coming up in the last week of our course, where we're going to talk about mainly Chapter 14, which we talked about tonight, managerial accounting, the determination of costs, direct, indirect, product, period, fixed, variable, and those definitions. And taking those cost numbers to Chapter 18, where we look at a cost volume analysis of taking those costs, fixed and variable, and determining our break-even point, which leads us to targeted income analysis. Next week, we're going to look at some problems involving Chapters 14 and 18 in class, and then we're going to talk about budgeting. Next week, budgeting. And that leads us into our final week, where we talk about capital budgeting and investment analysis, the finance side of this course. So the final examination will consist of mainly Chapters 14, 18, 20, and 24, and 1 question from the first 5 weeks of the class, Chapters 1, 2, 3, 12, and 13. And you'll get an outline on that next week. 60% of our course grade is yet to be determined. 15% this week in assignment 4, 20% in assignment, the case paper, and 25% in the final examination. So plenty of time to get that grade up or maintain that solid grade that many of you have as we complete the next 3 weeks of the class. Again, as I mentioned earlier, I'll stand by if any of you have any questions or concerns as you begin to put together assignment 4, the paper, and prepare for the final. We'll talk more about the final examination in next week's class as we prepare for that. The only other real difficult thing left in this class to do is what is called capital budgeting. And that's where you'll be doing some spreadsheet work that involves fixed cost, variable cost. And we'll talk about that as we move forward into next week. Some of you, if you've taken business finance earlier in your undergrad studies, might be familiar with capital budgeting or investment analysis, but we'll learn from scratch over the last week of our course. So I have recorded this class. I will post it to D2L into week 6 file folder as soon as it's processed. And that's about it for this evening. Take a look at your cumulative average in the course up to this point. Make sure you're familiar with that. Take a look at all your grades that have been posted. Make sure you're familiar and understand what we've done. And so we know have a good base as we head into this last 3 weeks of our course. Anybody have any questions or concerns as I wrap things up this evening? Okay. Thank you for being attentive. I apologize again for last week, but it didn't put us too behind. I think we're in pretty good shape. So if anyone has any concerns, please let me know. Have a great rest of the week. We'll see you next Tuesday. Good luck with your assignment and paper. Adios.
Thank you, Professor.
Thank you, Professor.
Thank you.
Sorry, quick question.
Yes.
For the assignment, I know it says 2025, 2024, but you said it was fine to do 24 and 23, right?
If they do have 25 information, I expect 25 information.
Okay.